Picture this. You open your banking app on a random Tuesday morning. You're not expecting anything alarming. You've been doing everything right. Paid your credit card on time last month, didn't miss a single payment, didn't go on some wild spending spree. You're being responsible. You're being the person your younger self would be proud of. And then you see it. Your credit score. It dropped. Not by 1 or 2 points, by 15, maybe 20, maybe more. And you just sit there, staring at that number. Because it doesn't make sense. You paid. You always pay. So why does the system feel like it's punishing you for doing the right thing? Here's the thing. You're not crazy. You're not missing something obvious. And you're definitely not alone. This happens to millions of people every single month, and almost nobody explains why in a way that actually makes sense. So that's what we're doing today. We're going to go slow, we're going to be honest, and by the time this video is done, you're going to understand your credit score better than most people who've had one for 20 years. Let's start from the beginning. When most people think about credit scores, they think in really simple terms. Pay on time, score goes up. Miss a payment, score goes down. It's almost like a report card. You do good things, you get a good grade. Simple. But that's not actually how it works. And the gap between what people think the system does and what it actually does, that gap is where a lot of quiet financial frustration lives. The credit scoring system isn't really designed to reward you for being a good person. It's not a moral score. It's a risk prediction tool. The people who built it, FICO, VantageScore, the credit bureaus, they're not sitting around thinking about whether you deserve a good score. They're thinking about one question. If someone lends this person money, what's the probability they'll get it back? That framing changes everything. Because when you understand that the system is trying to predict your behavior rather than grade your past behavior, suddenly a lot of the strange, maddening things it does start to make more sense. Not more fair necessarily, but more understandable. And once you understand why the score moves the way it does, you can actually work with it instead of constantly feeling blindsided by it. So let's talk about 3 things specifically, because these 3 things are responsible for the majority of those unexpected, confusing credit score drops that people experience even when they're doing everything right. The first is utilization, the second is hard inquiries, and the third is the reporting cycle, something most people have never even heard of. Part 1. Utilization, the most misunderstood number in your financial life. Let's start with utilization because this is the one that gets people the most. Your credit utilization ratio is basically the percentage of your available credit that you're currently using. So if you have a credit card with a $5,000 limit and you've charged $2,500 on it, your utilization on that card is 50%. Most financial advice you'll hear says keep utilization under 30%. Some people say under 10% is even better. And that's true, roughly. But here's what nobody explains clearly. Utilization is not a historical average, it's a snapshot. The score that gets calculated isn't looking at your average utilization over the past year and saying, hey, this person is pretty responsible on average. It's looking at your utilization right now, or more accurately, at whatever number got reported to the credit bureaus most recently. And that number can swing wildly from month to month, depending on when you charge things and when those charges get reported. Here's a real example that should make this click. Imagine you have 2 credit cards. Card A has a $3,000 limit, Card B has a $2,000 limit. Your total available credit is $5,000. Your normal monthly spending is $800. You're not going crazy, you're just living your life. Groceries, gas, a dinner out, maybe a streaming subscription or 2. $800. That's 16% utilization. Totally fine. But then one month, one completely normal month, something comes up. Maybe it's a car repair. Maybe it's a flight home for a family thing. Maybe it's a medical copay you weren't expecting. Whatever it is, that month you put $2,300 on your cards instead of $800. You still have the money to pay it. You pay the full balance when the statement comes. You do everything right. But your utilization that month hit 46%, and your credit score drops. Sometimes by 15 points, sometimes by 25 or 30, depending on your overall credit profile. You paid the balance in full. You didn't carry debt. You were responsible. But because of a temporary spike in spending, one that you handled, your score still took a hit. This is the thing that makes people feel like the system is rigged, and I understand that feeling completely. But here's the important nuance. The score will come back. Once that lower balance gets reported the following month, utilization drops and the points come back. Utilization damage is not permanent in the way that a missed payment is. It's more like a temporary consequence of a temporary reality. The system is taking a photo of your finances once a month. It doesn't know you paid it off. It just sees what the balance was at the moment someone snapped the picture. Now here's where it gets a little more layered, because utilization actually works on two levels. There's your overall utilization, which is all your balances divided by all your available credit combined, and there's your per-card utilization, which looks at each card individually. You can have low overall utilization but still get dinged if one individual card is nearly maxed out. So if you have 3 cards with plenty of available credit, but you tend to put everything on one specific card, that card's utilization could be high even if your total picture looks fine. The model notices both. This is why people who think they're being responsible sometimes get surprised. They're thinking about the total. The model is also looking at each piece. The practical implication of this, and we'll come back to this in the takeaways, is that spreading spending across multiple cards and paying attention to your statement closing dates matters more than most people realize. But we're getting ahead of ourselves. Let's move to the second thing.
Okay, so you've been sitting with your credit score for a while. Maybe you've been working on it. Maybe you're trying to rent a new apartment, or you're shopping around for a better interest rate on a car loan, or you're curious about a new credit card with better rewards, normal life stuff, adult stuff. And in the process of trying to improve your financial situation, you apply for a few things, maybe 2 or 3, and then your credit score drops. This is the hard inquiry problem. A hard inquiry, sometimes called a hard pull, happens when a lender formally checks your credit report as part of a credit application. This is different from when you check your own score or when a company pre-approves you for something. Those are soft inquiries, and they have zero effect on your score. A hard inquiry happens when you actually apply for credit, a credit card, a loan, a mortgage, sometimes even certain apartments or utilities. Each hard inquiry typically costs you around 5 to 10 points. Some people lose less, some lose more, depending on where their score is and how much credit history they have. The effect is usually small individually. But here's the thing. Inquiries stay on your credit report for 2 years. They only affect your score for about 1 year, but they're visible for 2. So here's the scenario that trips people up. You decide you want to refinance your car. You go to your bank, they run your credit. Then you go to a credit union to compare rates. They run your credit. Then you check one more lender online. They run your credit. 3 hard inquiries in 2 weeks for the purpose of being a thoughtful, financially responsible adult who is shopping for the best rate. And your score drops by 15 to 25 points. Now, there's actually a saving grace here that most people don't know about. For certain types of credit, mortgages, auto loans, student loans, the credit bureaus understand that you might be shopping around, and they give you a window where multiple inquiries for the same type of loan get counted as a single inquiry. Depending on the scoring model being used, that window is usually 14 to 45 days. So if you're rate shopping, doing it within a concentrated period of time is genuinely better than spreading it out. But for credit cards, each application is its own inquiry. There's no shopping window. Every application is counted separately. And here's the psychological dimension of this that I want to sit with for a moment, because it's actually kind of troubling when you think about it. The inquiry system essentially penalizes financial curiosity. It creates a quiet disincentive to explore your options. People who don't know about the scoring impact will apply for things freely and take the hit without understanding why. People who do know about it become anxious and hesitant, sometimes so hesitant that they don't apply for things that would genuinely help them.
They turn down better credit cards. They don't refinance debt they could refinance at a lower rate. They live with worse financial products because they're afraid of a temporary score drop. That's a real psychological cost, and it's worth naming even if there's no clean solution to it. The score does recover. Inquiries age off. 6 to 12 months out, most of that impact is gone. But in the moment, for someone who doesn't understand why it happened, it feels like a punishment for trying. This is the one that I find the most fascinating, and honestly, the most important, because it's the one that creates the most confusion for the most people. Your credit card company, and your bank, and your loan servicer does not report your balance to the credit bureaus every single day. They report it once a month, and that reporting date is usually connected to your statement closing date, not your payment due date. Let me say that again because it's important. Your statement closing date and your payment due date are two different things. The statement closing date is when your billing cycle ends and your statement is generated. The payment due date is when you actually have to pay that statement, usually about 20 to 25 days later. The number that gets reported to the credit bureaus is typically your balance on the statement closing date, not your balance when you actually pay, not your balance in the middle of the month. The closing date balance. That's the photo. So here's what happens. You use your credit card throughout the month. Let's say you spend $1,500. Your statement closes. At that moment, your reported balance is $1,500. A few days later, the credit bureau gets that information, recalculates your utilization, and your score might drop because that $1,500 balance puts your utilization higher than it was before. Then you pay the bill in full. You pay every single cent. Your actual balance goes to zero, but the reported balance is still $1,500 until the next statement closes and gets reported, which is another month away. This is why people look at their credit score mid-month after making a payment and are confused that the score hasn't moved or has even gotten worse. The payment hasn't been reported yet. The system doesn't know you paid. It's working from last month's snapshot. And this creates this bizarre situation where two people with identical spending habits and identical payment behavior can have completely different scores in any given month just because of when in their cycle someone happened to check. There's also another layer to this. Not all of your creditors report on the same day. Your credit card from one bank might report on the 15th. Your card from another bank might report on the 22nd. Your auto loan might report on the 1st. So your credit score is being continuously recalculated based on a patchwork of snapshots taken at different moments in time by different institutions on different schedules. This is why your score can change even in a week where you've done absolutely nothing new with your finances. Something got reported, some balance updated, some calculation shifted. The score you see on any given day is less like a thermometer reading your current financial temperature and more like a collage made from photographs taken at different moments in time. It's a representation of reality, but it's not a live feed. And understanding that distinction is actually really freeing once it clicks, because it means you stop treating every single fluctuation as a crisis. The intersection, when all three things happen at once. Here's where I want to zoom out for a second, because these three things, utilization spikes, hard inquiries, and reporting cycles, don't always happen in isolation. Sometimes they collide, and when they do, the drop can feel genuinely alarming even when you've done nothing wrong. Think about this scenario. You're getting ready to move. You apply for a new apartment. Hard inquiry. You have some moving expenses come up on your credit card. Utilization spike. Your current credit card statement closes at the peak of your spending. The high balance gets reported, and all of this happens in the same 30-day window. You could be looking at a 30 to 45-point drop on a completely normal month of adulting. No missed payments, no debt spiral, just life happening at an inconvenient intersection of three separate scoring factors. The score will come back. It almost always comes back when the underlying behavior is sound. But in the moment, 30 to 45 points can feel catastrophic especially if you're watching it because you're about to apply for something important, like a mortgage or a car loan. And this is where the anxiety really lives for most people, not in the day-to-day fluctuations, but in the fear that a drop will happen at the exact wrong time, that you'll apply for the mortgage you've been saving for and the score will be in a temporary dip because you just paid for a wedding or a medical bill or a cross-country move. That fear is valid, and rather than dismissing it, I think the right thing to do is give you some actual tools for working around it. Here's the reframe I want to offer you, and I want you to sit with it for a moment. Your credit score is not a grade, it's a signal, and like any signal, it has noise in it. When meteorologists predict rain, they're not right 100% of the time, not because they're incompetent, but because the system they're measuring is complex, and the models they use are approximations. The weather is real, the prediction is an interpretation. Your credit score works similarly. Your actual financial health is real. Your score is an interpretation of it. And like any interpretation, it has limitations. It gets noisy. It picks up information that isn't always perfectly representative of your true picture. The mistake most people make is treating the score as if it's the thing itself, as if their score is their financial health. And when the score moves for confusing reasons, it feels like their financial health is deteriorating, like something is wrong with them. But a temporary utilization spike doesn't mean you're bad with money. A cluster of hard inquiries doesn't mean you're financially desperate. A reporting cycle that captured your balance at its peak doesn't mean you carry debt recklessly. These are artifacts of how the system works, not true reflections of who you are or how you handle money. This matters psychologically, because when people believe their score reflects their worth or their capability, every dip feels personal, and that personal feeling drives bad decisions. It makes people overcorrect. They stop using their credit cards entirely, which can actually hurt the score in different ways. They become so anxious about every point that they can't make normal financial decisions with clarity. The healthier mental model is this: understand the system, work with its rhythms, and don't confuse the signal for the truth. Your financial truth is in your behavior, whether you pay, whether you save, whether you live within your means. The score is just a noisy measurement of that truth. And once you understand the noise, you can stop mistaking it for the signal. All right, let's talk about what you can actually do with all of this. None of this is going to feel extreme or overwhelming because it shouldn't be. This is about working smarter with a system that already exists, not overhauling your entire life. First, understand your statement closing date, not just your due date. Log into your credit card account and find your billing cycle, specifically when your statement closes each month. That's the date your balance gets reported. If you have a large purchase coming up, paying it down before that closing date means a lower balance gets reported, which means lower utilization gets calculated. You don't have to pay early in some stressful way. Just knowing the timing helps you make smarter decisions about when to pay and when to charge. Second, think about utilization across all your cards, not just one. If you tend to put everything on one card because you like the rewards points, and honestly, I get that, that's smart, just be mindful of what it does to that card's individual utilization. Sometimes it makes sense to spread a larger purchase across two cards, even if the rewards are slightly worse, because keeping each card's balance well below its limit matters to the scoring model. And if you can, keeping your overall utilization below 20 to 25% as a general habit, not an obsessive goal, just a general habit, tends to keep your score in a stable, healthy range without requiring constant monitoring. Third, be strategic about when you apply for new credit. If you know you have something important coming up in the next 3 to 6 months, a mortgage application, a car purchase, renting a new apartment, that's probably not the time to apply for a new credit card, even if the offer looks great. The hard inquiry and the average age of accounts both take small hits when you open new credit. Timing matters. Conversely, if you're in a stable period with nothing major on the horizon, that's actually a reasonable time to shop around or upgrade your financial products if you've been meaning to. The score can take a small hit now and recover before you need it for something important. Fourth, if you're shopping for a loan, cluster your applications. If you're going to shop for a mortgage or a car loan, which you absolutely should, comparing rates is financially intelligent. Try to do all your applications within a 2-week window. Because of the rate shopping protection built into most scoring models, those inquiries will likely get grouped together and treated as a single inquiry rather than several separate ones. The exact window varies depending on which scoring model your lender uses, but generally speaking, speed is your friend when you're comparison shopping for the same type of loan. Fifth, check your credit report, not just your score. Your credit report is the underlying document, the actual record of your accounts, payment history, and inquiries from which your score is calculated. You're entitled to a free copy from each of the 3 major bureaus once a year through the official government-mandated site. Looking at your report tells you not just what your score is, but why it is. And sometimes you'll find errors. Incorrectly reported late payments, accounts you don't recognize, balances that don't match reality. Errors on credit reports are more common than most people assume, and disputing them, which you have the legal right to do, can sometimes resolve score drops that had nothing to do with your actual behavior at all. Sixth, let time work for you. This one sounds passive, but it's actually really important. The average age of your credit accounts is a meaningful factor in your score. Opening lots of new accounts in a short period lowers that average. Closing old accounts can also hurt it, sometimes. Generally speaking, keeping your oldest accounts open, even if you don't use them much, and being selective about when you open new ones helps your score maintain stability over time. Time is doing quiet work in your favor every month you're consistent. And this is the part of the credit score equation that rewards patience more than cleverness. Seventh, know what your score is actually for. This one is more philosophical than tactical, but I think it's worth saying. Your credit score matters most when you need to borrow money for a home, a car, sometimes a rental, occasionally a business. It matters somewhat for insurance rates in some places and for certain professional background checks. In those contexts, a good score can save you real money through lower interest rates and better terms. But outside of those specific moments, your credit score is not a daily measure of your worth or your progress. Some of the most financially secure people I've ever read about or studied had mediocre credit scores because they didn't borrow often. Some people with excellent scores are quietly drowning in high-interest debt that they're managing just well enough to keep the score intact. The score is a tool. Like any tool, it's useful in specific situations and irrelevant in others. Don't let it become the central metric of your financial identity because it was never designed for that role. I want to end with something that I genuinely believe. The reason credit scores feel so confusing and frustrating to so many people isn't because those people are bad at money. It's because the system was never really explained to them. Not in school, not by their parents usually, because their parents didn't know either. Not by the banks, who have very little incentive to make you an expert at navigating their systems. So you ended up in adulthood with this number attached to your name, this number that affects where you can live and what you pay for loans, and sometimes even whether you get certain jobs. And the rules of how it works were just never clearly given to you. That's not your fault. That's a gap in financial education that has existed for decades and affects people across every income level, every background, every age group. And I think when you understand that, when you realize the confusion is structural and not personal, something loosens a little. The frustration doesn't disappear, but it stops feeling like evidence of your own incompetence, because it was never about competence, it was about information. You now know what most people don't. You understand that utilization is a snapshot, not a verdict. You understand that inquiries are a temporary cost of financial exploration. You understand that the reporting cycle means the score you see today is always a little bit behind reality. You understand that when the score drops despite doing everything right, It's usually the system being the system, not you doing something wrong. And that knowledge changes things. Not dramatically, not overnight, but quietly and consistently, in the way that real financial progress almost always works. Not through some dramatic turning point, but through a slow accumulation of better understanding and slightly smarter decisions made over time. Your score is going to fluctuate. That's just how it works. But the underlying habits, paying consistently, keeping balances reasonable, being thoughtful about new credit, those habits compound in your favor over months and years in ways that no single-month fluctuation can undo. So if you checked your score this week and it was lower than you expected, and you've been doing your best, I want you to take a breath. Look at your behavior, not just the number. Ask yourself whether you've been consistent. And if the answer is yes, then trust that the number is the one catching up to you, not the other way around. Progress beats perfection every single time. That's what I've got for you today. If this helped something click that's been confusing for a while, I'd genuinely love to know. Drop it in the comments. It helps me understand what to dig into next. And if you know someone who's been quietly frustrated by a credit score that doesn't seem to make sense, share this with them. Sometimes the right explanation at the right moment changes how someone sees their whole financial picture. Take care of yourselves. I'll see you in the next one.